So I am Laurie Lane-Zucker. I am the founder and president of Impact Entrepreneur. We're a global network of tens of thousands of entrepreneurs, investors, academics, other impact practitioners in over 200 countries. If you haven't visited impactentrepreneur.com, our magazine that covers business and finance innovations that advance the SDGs and related issue areas in every region of the world, please do. Please become a member and reader. Join our webinars that we do very frequently. And if you want to know more about our work, please find me. I'm here all day, or send me a note. So I'm happy to introduce our panel, which is on investing in technology and also philanthropic catalytic opportunities in Africa. And I'm very happy to introduce our two panelists. I'm just going to briefly introduce them and they can come up on stage. Dr. Ola Brown is the founding partner of Healthcare Capital Africa, also known as HealthCap, a Pan-Africa investment company focused on investments that create a healthier world. Great. And our next panelist is Maya Horgan Famodu, and she is the founder and general partner at Ingressive Capital, a $10 million Fund 1 and $50 million Fund 2 venture capital firm targeting pre-seed and seed stage startups across Sub-Saharan Africa's key tech markets. So I'm going to just ask each of you to introduce yourselves a little bit more fully and tell us, I'd love you to share a little bit more about kind of your professional trajectory that might have led you to what you're doing now. And and of course share about what you are doing now. Ola, do you want to go first?
So I have like the weirdest professional trajectory because I started off as a physician, working in emergency medicine in the UK, working for the NHS. And that really got me starting to think about the difference in healthcare that I could provide in England compared to what was obtainable in Africa. And after my housemanship, I think you call it residency here, I decided that I wanted to do something in Africa. So I went and I set up the only thing that an emergency physician can do, really. I set up an emergency company that became the largest emergency services company in West Africa. I had a liquidity event in 2015, which now got me starting to think about investing. And after an unsuccessful stint in public market investing, I settled in the private markets, raised my first fund in 2015. That became one of the best performing funds in Africa. We did a 5x DPI, which means that we're able to return 5 times the money that our investors gave us, making it not just one of the best performing funds actually in Africa, but one of the best performing top quartile performance in the world. I hold a master's in finance, a PhD just finishing in finance, focusing on digital currency, and currently raising Fund 2 to invest in Nigeria, Kenya, Egypt, and South Africa, which are 50% of African GDP, 56% of Africa's consumer market. We are just approaching our first close of that fund. So that's, my professional trajectory so far, from medicine to investing.
Thank you, Ola. Maya?
I know I have a very American accent, but I am half Nigerian and have lived in Lagos for the last decade. I think the most important part about me is Ola's my best friend, so we're cheating. As far as my background, I grew up in rural Minnesota. My dad and all of his brothers moved from rural Nigeria to rural Minnesota for higher education, and they all settled down with Swedish Minnesotan women, and here I am. I started my first business in Nigeria after college. I worked for about 7 months and then moved to Lagos and launched an advisory company. And so we assisted some of the world's leading venture funds and technology companies to enter and operate across Africa. It was like their first entrance into Africa. It was still, investors' main questions were still is there internet there? Or how can there be coders if people can't read in Africa? Less like, what was the most recent exit, which is now the questions that people are asking, fortunately. But our clients were like Google, GitHub, Y Combinator, Techstars, 500 startups. For some of these clients, we helped them just enter the market and make their initial investments. For others, we actually operated their Africa strategy over 1 to 2 year subscriptions. That company was profitable. I started investing the profits into tech businesses. Tried to get a job at a VC fund, but nobody would hire me. So I just like, guess I'll just have to start my own. And then I launched Ingressive Capital. We have our first fund fully deployed. We've had 4 exits from our first fund. Actually, Ola and I were in Paystack. That was my first fund investment that sold to Stripe. That was like 41x our initial investment. So Africa does return money if anyone's interested. It's not exclusively the impact, but it's a combination of both, which I'm excited to talk more about. We also have a nonprofit called Ingressive for Good, where we've trained hundreds of thousands of African youth in technical skills. We focus on developers, designers, product managers.
Great. So I've got a few questions lined up, and I'll probably insert 1 or 2 more into the conversation. And please do use those note cards to write your questions, because we're definitely going to take time toward the end to get to at least a few of them. In our prep conversation, we've talked a bit about kind of hyperlocal innovations and perspectives, and how your firms are working with those who are really seeing needs at the local level or regional level in Africa and responding to them with their enterprises and having some success. So I think it'd be great if the audience could hear a few examples or case studies of what this kind of enterprise looks like. Ola?
So examples of businesses with a hyperlocal approach. I think one of my favorites actually is what's the 4th biggest smartphone maker in the world after Apple and Samsung. And it's a company almost exclusively focused on the African market, $10 billion in revenue, and it's called Tranison. And when they came into the African market, they did something very different from Apple and Samsung. Obviously, their pricing is different, but also I think the main innovation came in their cameras. And if you look at even the big, really famous photographers, right? There are always complaints when you see a Serena Williams shoot or a Simone Biles shoot that black skin isn't photographed properly. So Tranison got in a lab and spent 2 years innovating around their camera lens. And they have 2 brands, Techno and Infinix, which take the most flattering pictures of black skin. And big on Instagram, social media, Nigeria, Kenya, anybody that's familiar with those markets knows about the obsession with social media and pictures. So those phones became the biggest phones in Africa by default because of this one tweak that they made with the camera. And $10 billion is a lot of money. The 4th biggest smartphone manufacturer in the world having an almost exclusive African market is a big achievement. And as big as the Apples and the Samsungs are, I'm sure that they could do with an extra $10 billion. Nobody would refuse that. So I think that's one case of hyper-localization that really became a resounding success. I think the second one that I really like is Biggie Drinks, because they're slowly driving Coca-Cola out of Nigeria. And Coca-Cola is a several decades old company, right? Whereas Biggie Drinks started 5 years ago, and they've already taken 30% of the beverage market in the UK, in Nigeria. And again, it's this sort of hyper-local approach, right? Cutting costs in the value chain, appealing to the Nigerian palate, appealing to the local influencers and local marketing, and have, I have a friend in Coca-Cola, and he says when he's going in on Monday, he doesn't know how many teams are going to be missing. They've suddenly all been poached and gone to this Biggie Drinks company. So, it's exciting to see African homegrown challenges to, global companies that have been doing this for decades. And, you wouldn't think that mean, he's not even an FMCG person. It's not as if he worked in Procter & Gamble. I think he was a photographer before he started Biggie Drinks. So it just shows like how this hyperlocal approach works and how they can take market share from really big companies. And the third example that I'll give, and the last example, is my favorite because we talk a lot about fintech exits and fintech in Africa, but one of the biggest sort of exits in Africa was actually a health tech, InstaDeep. That was sold to BioNTech, the big vaccine company, but also one of the most innovative biotech companies in the world, for almost $1 billion. And they used AI to speed up the process of drug discovery. That was their innovation. And now that's at the center of one of the most, their technology, African technology, is at the center of one of the most innovative companies in the world, producing drugs for everybody. So I think while I've been at SOCAP, I've been to a ton of sessions, and it's all been like, you know, very American-centric. A lot of them have been centered on the American market, and that's a great thing, right? But I think, you know, the last point that I'd like to make about these hyperlocal approaches is, you know, this example is of how African innovation is benefiting everybody. And probably, to be honest, the American and European markets, probably before the African markets, because they concentrate on, you know, cancer drugs and sort of immunology and expensive drugs that, you know, Africans can't really afford. So it's to say that investing in Africa actually, you know, I believe that the best innovators in the world can come from anywhere and look like anyone. And I think the last point is about the power of African innovation and African innovators to contribute to global prosperity, but also contribute to global innovation and helping us live, you know, healthier, wealthier lives.
So I will actually start at the bottom and work up. And with our nonprofit, as I mentioned, Ingressive for Good, we focus on people who have no background in technical training. It could be former hairdressers, former market women, people selling yams on the street, and we pay them to learn over a course of 3 months. And there's a peer system, so their peers teach them. And at the end of the 3 months, we showcase them to some of the local and international firms who are looking to employ. And I'll give a few examples of what happens when you give a little bit of internet and a little bit of advice and a little bit of technical training to African youth, regardless of where they are based. And as Andela, their tagline, brilliance is evenly distributed, opportunity is not. Here are some examples of how that actually takes place. So we had a hairdresser making about 20,000 Naira, and today's is about $10 a month. Yeah, so today about $10 a month. She participated in one of our technical training programs to become a designer, and she was making about $2,000 a month after that, and able to put her siblings through school, able to pay for her family to go to have a home, able to provide healthcare. In Nigeria and most countries across Africa, there's not government infrastructure, so there's not healthcare. If you lose your job, there's not housing, there's not. It's basically the person who makes money in the family pays for the closest 30, 40 people around them. And so we've seen so many examples of not only elevating individual families or individuals, but then being able to elevate their entire community. Another example is a designer who participated in our program from the north in Nigeria. And we have stories of people who, you know, walked several miles so they could go to a power system so they could charge their laptop overnight and just code by candlelight, you know, overnight before they went back to their day job. And we had an example of one of these gentlemen. He did the design course, and he worked on the most recent Black Panther and now has a job in Silicon Valley. And so we have so many examples of when you give a little bit of technical training, a little bit of internet access to anyone on the continent, the incredible things that can happen. We had 2 founders in our portfolio now. The company is called Gray. They're a payment platform. They're in our Fund 1. And the 2 gentlemen went to school in Nigeria, didn't have a passport, had never even left their state in Nigeria, participated in our Ingressive for Good campus program, went on to start a company, participated in Y Combinator, raised it a $30 million post-money valuation, and are now making about $1 million a month in revenue and are profitable. And not only is this transforming their lives and has allowed them to receive liquidity, but when we enforce ESOPs or encourage ESOPs, this allows the whole executive team or the whole company to then build wealth. And we've seen that also with Paystack. With the two founders that we mentioned that sold to Stripe, they had an ESOP. So not only was it that Shola and Ezra, the two gentlemen, again, locally educated, locally employed before they went on to start their company, but when they exited, we had a new generation of angel investors and entrepreneurs who were able to seed their own businesses and also be backing the businesses of those around them. And so this altruistic, very communal system that we have in place has allowed the ecosystem to really develop and grow. And so if you're thinking of solutions that you want to bring or how to contribute, any platform, just giving internet. You don't need to sit with the person and train them every day. There's just the smallest amount of access transforms the continent and the people in it.
So like in Nigeria, just like there's a PayPal mafia here, we call them the Paystack mafia because like of the wealth that has been created and come back into the ecosystem.
Thank you. So my next question relates to Africa as a set of countries, of individual countries in Africa as a whole. And I'd love it if you could share your thoughts on the opportunities or lack of opportunities that exist when one sees Africa as a continental market versus Africa as a collection of individual countries, markets, and economies. And I'm also interested in what are the opportunities for intra-African trade that you're seeing.
So this has been a big topic over the past few years around most of the trade in Africa today is Africa to Europe or Africa to Asia. And in terms of intra-African trade, historically there wasn't enough trade between African countries, but that's changing. And I'll give an example of a South African company, MTN, that came into Nigeria and became the biggest telecommunications company in Nigeria, making more money than it did in its home country, South Africa. And within our portfolio now, we see companies primarily in these 4 countries where we invest, Nigeria, Kenya, Egypt, and South Africa. They're operating over 15 African countries. So there's been really a lot of intentionality by the African Union bringing together what's called the African Free Trade Agreement, which encourages intra-African trade and the formalization of intra-African trade as well, because a lot of trade, I think the actual amount of intra-African trade is actually underestimated because there's a lot of cross-border trade that goes through informal channels that isn't really captured. So I do think that looking at regional collectives like ECOWAS, like the sort of South African collective, the East African Economic Zone, where a lot of trade happens, the Francophone African countries as a block where you can scale through several countries at the same time that have, similar monetary policy, at least similar and the same currency, is a useful way to invest in Africa and look at sort of the continent as look at some countries as an entry point and then scaling to other countries. Obviously, macroeconomics differ. Sometimes currencies differ outside the Francophone African bloc, but there are similarities, I think, in terms of consumer behavior. So I gave the example of Tranison, which is a Pan-African multi-billion-dollar company that sort of distributes its products across Africa. So there are tweaks that you have to make to the business model to make it work in different countries. But I do think inter-African trade is important.
And you'll notice we're not exclusively focusing on the impact element because any business that we're investing in, barring betting, et cetera, is inherently impactful. Not only is it building 0 to 1 wealth, but it's, we invest in a fintech company. We talk about its scalability, the fact that it's, a financial technology company, the background and technical skills of the founding team. But at its core, it's a financial inclusion business. And so we may be focusing on the for-profit side of this and the scalability, but that's because, I don't want to speak for you, Ola, but believing that sustainable impact is rooted in sustainable economics. So with that, the one note that is always important for our portfolio and how we also talk about we're Pan-Africa, we're not single geography funds, you'll rarely find those because Africa has, in majority of the countries, some of the fastest growing GDP rates in the world. And when you have, 5 to 15% GDP growth, Some years there will be a contraction. We have shorter recession cycles than the Western world, where you're between 0 and 2% GDP growth. When you're at an 8% growth, there'll be exponential growth and then a quick contraction to adjust. Exponential growth, a quick contraction. And so if you were overly concentrating in one geography with that model, then you would be exposed to the contractions, which would mean inflation, recession, devaluation, et cetera. So that's part of the reason that we think Pan-Africa. And also in what Ola mentioned, there are similar problems across the continent. We don't invest in South Africa. The per capita GDP is 5,000. You can drink water from the sink. There's generally structured infrastructure. You can drive on the roads without facing major challenges around logistics and transportation. Not really the case in the other markets where we're investing, so we don't see it similar enough to Nigeria, Kenya, Egypt, Morocco, et cetera, to add it to our portfolio. But the way that we think about it in Pan-African diversification is we look at the GDP construction of the countries where we're investing. We also look at the per capita GDPs. We generally invest between 2,000 and 3,500, and we just make sure that we are investing in complementary markets. Like Egypt does not have a simultaneous recession to Nigeria, does not have a simultaneous recession to Kenya. So really trying to be thoughtful about investing in markets that have similar infrastructure, that have similar consumer demographics, and also don't all drop or radically scale at the same time. And that's really helped our portfolio companies, like the Paystacks, the other ones where we've seen exits, is they've expanded across the continent, so their revenues are relatively stable when one is sort of going down or way up.
Maya, you earlier used as an example the work that you're doing, the investment you're making in early training, initial training, and the incredible ripple effect that you see from that. To me, that is a obvious place as we have now a discussion around the opportunities for catalytic philanthropy. That seems like a really good opportunity for catalytic philanthropy to make a real contribution to growing enterprises and impact throughout Africa. Do you have other examples or ideas that you can share of areas where catalytic philanthropy can really have a huge impact?
Certainly. I'll break that into two parts. Firstly, within our portfolio and how we go about assessing opportunities, or sort of what is our thesis. We are investing in financial inclusion, in well-being, in marketplace, and actually a core part, all of our investments have to have indigenous equity owners. So that's two-sided. From the impact side, we want to build indigenous wealth. We want to make sure that, businesses that are growing and selling and making their money from Africans are also repaying when those businesses succeed. And something that we found that's very interesting in our portfolio, when I first started this almost a decade ago, I thought, okay, the model of the most successful co-founding team will be people who went abroad and studied at the Harvards and MITs and worked at Googles and then came back to the continent. And so we started looking for those founders and investing in those founders. And then over time, we realized actually, we did an assessment of all companies across Africa that had raised $10 million or above, and we realized actually the highest returns are from people who are indigenously educated and spent time and deeply understand their customer demographics, and also because there is still a trust-based society, stayed local and built relationships with people, and where we could really add value. Maybe, as I mentioned, the Paystack founders, they didn't have passports at the beginning of their business. A lot gray founders, a lot of the founders in our portfolio had never really left their state before. But we knew that we could also add value to the business. Exceptional founder, knows the market, just got a little bit of access to resources, a little bit of access to technical training, built something great, and then they just needed us to give them access to later stage capital or some of those later stage business development relationships. But if we're thinking about how we can be helpful, it's not necessarily getting in the way of the founder and deeply mentoring or having to go on ground and teach them how to do things. It's just giving access. So whether that's funding, whether that's access to business relationships, it's literally just giving access.
Thank you. Ola, I'd love to hear your thoughts on this broadly, especially ways in which philanthropies can engage across their capital stack. I mean, not simply through grants, but also, say, through PRIs or those elusive MRIs. guarantees. Can you talk about those kinds of opportunities?
Absolutely. I think, you know, how development happens is, and how development has happened historically, is partially through sort of internal and domestic capital stacks, but also through cross-border investments. And I can remember growing up in the UK and America still being like an odd place. So I can imagine sort of like 100 years ago when Europeans were taking bets on America, it was a highly risky sort of exotic, esoteric investment. It was the Wild West, but there were still families and merchants that were adventurous enough through brokers, like the JP Morgans, like the famous American bankers originally, to bring European money into America. And that's how America industrialized, right? It was built on the back of European funding. And that went into infrastructure, it went into railroads, it went into factories. But it was a lot of European money being carried from Germany into London and shipped in cash and gold into New York, and then sort of being like, you know, transported across the country. And in the same way, you can see the instrumental and catalytic effect that institutions like the IMF and the World Bank had in Asia. And that was like American money, right, helping to develop Asia. So I think that some instruments that are sort of philanthropy-based are things like you said, for infrastructure at least, like first loss guarantees. Because the reason why I told the story about growing up in England and people being like, oh, you're going to America, or, you know, I hope you don't lose your values, is because America, even at that time in the 90s, was still seen as sort of kind of exotic. And I think that people do place a somewhat unfair risk premium on African investments. I can remember I was in London a few weeks ago, and some British investors were asking, you know, why would we put our money in Africa when we can keep it here? And I asked, you know, when was the last big tech listing on the London Stock Exchange? And the whole room went quiet, because there hasn't been. In Britain today, there's about $700 per person going into venture capital, yet there've hardly been any unicorns. In Africa, it's about $1 or $2 of venture capital per person, yet we've had tons of unicorns and tons of listings. So there's a really great arbitrage opportunity, but I think what the guarantees do is they de-risk that opportunity in the minds of commercial investors. And I think that that's something that philanthropists can really, bold philanthropy can really bring to the table. Either these sorts of first loss guarantees for commercial investors that want to come into Africa, but just like Britain, sort of, even up until the 90s, see it as a bit exotic, see it as a bit risky. We're always asked about political instability. You know, I was on Twitter watching, like, I can't remember whereabouts in America, but there was a ballot box on fire somewhere in America. But they're like, oh, you know, don't you have these, like, very risky elections and political risks in Africa? And I think that there's a way that philanthropic capital can de-risk it through some of these instruments. And that works for venture capital funds, it works for infrastructure as well. For philanthropic capital to come in and be an anchor investor, so anchor the funds, bring in other people. That's a way that it can be catalytic, right? A foundation or a philanthropic organization saying, you know what, we'll take on the risk, we'll be the anchor investor, we'll get this fund to first close. And it could be a private equity fund, it could be a venture capital fund, it could be an SME fund, being the first mover into the fund, or saying, you know what, commercial American investors, we know you're afraid. So we're going to provide, you know, a guaranteed 5% return, and, you know, whatever happens, you'll get like 1x back or 2x back. And then that sort of allows, sort of changes the risk premium in the heads of commercial investors, and allows them to deploy capital perhaps into somewhat projects, funds that might be initially perceived as risky, but obviously the philanthropic organizations and I think the non-profit sector has a much deeper institutional knowledge of Africa. You've been in Africa for a much longer time, you understand the terrain. Most people that I speak to here don't think that I can drive from Nigeria to Kenya in an hour. But if you go to the commercial sector, there's still the sort of ignorance around Africa, and I think that that's where the non-profit and philanthropic organizations can be super powerful with that combination of capital and institutional knowledge about the continent to be able to de-risk that money for commercial investors. Because what Africa really needs is that commercial investment. Every single non-profit is spending somebody's profits. And in order for Africa to develop, we need jobs, sustainable jobs, we need businesses, we need investments, and that needs to be on a somewhat commercial basis, right? If you look at the countries that got independence at the same time as Nigeria and Ghana, so if you look at like Singapore, for example, if you look at Vietnam, if you look at the Asian countries and their trajectory, which was more commercial and more trade orientated, as opposed to the African trajectory that was more, you know, sort of philanthropic and aid orientated, you can see that, you know, in terms of lifting people out of poverty, Asia did a lot better than Africa. So I think that that's where philanthropic capital can be super catalytic.
Maya?
And one more point on just to add some actual numbers. So Ola mentioned MTN, which is the largest telecommunications company in Nigeria. So when they initially came in, they thought that they would have about 5,000 lines that came into Nigeria. And then 150 million lines later, they realized there was something to be said for Africa, specifically for Nigeria. And a place, so I keep mentioning this, and if you don't remember anything else, just remember giving access to resources. You don't have to go there, you don't have to hold hands, just give access to basic resources. And that means technical tools, and that means technical access. And so just to put into context, in Nigeria, per capita GDP as of 2022, 2023, now there's been devaluation, but we'll say pre-devaluation, per capita GDP about $2,000, $1,900, and a cost of a gigabyte of data is $2.20. $2.20. There's no such thing as unlimited data. So material portion of people's income is going to the cost of internet. And so if we can do anything to make that more accessible so that people can get online and learn, because really, one of our programs, we partnered with Coursera. Do you all know Coursera? It's a education tech platform. You can take classes online. We had the highest engagement in Coursera's history when we gave out unlimited accounts to some of our Ingressive for Good trainees across the continent. Highest engagement in Coursera's history. And that's because when a little bit of resources, a little bit of access is given, people take advantage of that opportunity to the greatest extent. And so when thinking about philanthropic initiatives, where your money can go, it's very unsexy and it seems very uncool, but telecommunications infrastructure, like internet infrastructure, Wi-Fi centers, ISP, just places where people can learn or come and get access to internet connection. That in and of itself will transform the continent.
Thank you. Wonderful. So my next question, I'm going to merge with a question that's come from the audience. So for maturing and successful companies that have been birthed on the African continent, there is often interest from foreign businesses and investors to buy those enterprises. Is this a positive or negative for the companies, for the investors, for consumers, for African countries, and for Africa as a whole? That's my question. And the question from the audience member is, as investors bring capital to the African continent, is there a way to protect growth and returns such that investment doesn't become extractive?
ESOP. Just make sure that employees get access to shares in the business. And with venture capital, you know, historically about 80% of the venture capital coming to Africa was from foreign investors. And when we originally started this, people, at first, there was a lot of resistance. Why are you bringing Y Combinator to Africa? Why are you bringing Google? Why are you bringing 500 startups? We should be investing in our own. Trust and believe. I tried. And Africans are so resistant because interest rates on the continent between 20 and 30%, the amount of money that Africans based on the continent have, the returns they have to make in order to just beat devaluation, sometimes doesn't make sense for venture capital. And so, and the risk profile from not understanding and not having any history in investing in young people, building this on building an idea where there's no tangible assets, that was very unfathomable 10 years ago when we started this, where in countries where the majority of wealth was built from extractive industries, from oil and gas, from traditional industry. And so it was necessary to bring in foreign capital so that at least local investors could have some idea of, oh wow, returns really could be made. You know, if you look at the cap tables of Paystack, of Carry First, we have one company, they'll make nearly $40 million in annualized revenue this year. Who were the initial backers? Andreessen Horowitz came into that deal, and guess what it did? It validated and provided access to liquidity event, to secondaries for some of the local investors who had come in. So my belief, it is transitioning now. There was 80% of total venture capital that came into African tech was foreign, and that gave real data points that allowed for growth stage firms to be launched across the continent. And now we have 5 growth stage funds that are between 100, 250 million, 300 million across the continent, where we can look to our own African GPs to be taking on our secondaries and to be doing the follow-on investments into portfolio companies. But as Ola was talking about, that sort of risk capital or more risk tolerant, or being able to come in and take those initial bets, it wasn't local Africans who were willing to do that. Yes, to start the businesses, but to back them, there needed to be foreign investors. And again, we are not taking exploitive terms. We're seeding companies and looking at, 10, 12%. Each round is between 5 and 15% ownership from the venture firm that comes in. And so when these companies exit, they still have majority ownership. So yes, I think that foreign capital has historically facilitated the growth of the ecosystems, been necessary to build the data points and validate such that local capital can start to back it. The Sovereign Wealth Fund, we were the first tech VC that they've ever backed, the Nigerian Sovereign Wealth Fund. They were investors in our Fund 1. And they were the very last investor to come in the fund. After guys from Y Combinator, after guys from Google, after guys from all these Western investors, all these fund of funds from the Western world. Why? They needed the data points. They needed the validation. They needed to be sure that this was a legit business. So yes, I think it's only been beneficial.
And, I don't think history necessarily always repeats itself, but it rhymes. And if you look at sort of the development of America, I think I've alluded to that in my previous conversations, a lot of American development funding came from Europe, right? And at some point, when America had enough domestic capital of its own, you stopped taking so much European capital, and actually burnt a ton of their tea, if I remember correctly. But that was like a turning point in American history, right? When, Britain was being quite extractive and bringing in a lot of the money and bringing in all of the tea. And America started brewing its own tea and asserting its own independence. And I think the same thing has happened with China, where American, at least influenced institutions, were the primary investors in China. But now we see China pushing back and saying, well, we have our own domestic capital markets now, and we want to develop in our own way, and we're not so reliant on Western money anymore. So I think that, the initial phase of investment, of development of sort of any country or group of countries is generally a mix of domestic capital and foreign investment. And that builds a domestic capital up enough to the point that, those countries can start pushing back and saying, hopefully there'll be no tea burning in Africa, but at some point we'll have enough domestic capital not to be so reliant on American capital. But if you're looking at sort of why I'm so passionate about tech and why I think that tech and tech investments are so important is because of the speed, right? And because tech innovation doesn't progress linearly, it progresses exponentially. So if you think about China, in 2008, there were no unicorns. By 2018, there were almost 100. Companies valued at $1 billion or more. So what we're seeing is a similar sort of trajectory in Africa where, 10 years ago when I first raised my Fund 1, and by the way, my Fund 1 was raised from all local investors. So I'd never been to America at the time I raised my fund. I hadn't stepped foot in America. So it was all local investors. Every single one of those people, I had to spend a lot of time educating about venture capital, and they all backed me. They were all local. So it's not always foreign capital, right? I didn't have a single foreign investor because I sort of never traveled here before. So there are local capital stacks, but I think that in the initial stage of development, there has to be a mix, and that's what we see has panned out in America, that's what's happened in Asia, and that's what's beginning to happen in Africa as well.
Thank you. I just want to say for the benefit of any Brits in the audience that as a resident of Massachusetts, I'm happy to say that we do drink tea these days there. We don't just throw it in the harbor. Next question, I'm just going to go, we've got a lot of questions coming in from the audience, so let's switch over to them. Some of the examples, mobile phone company, tech companies, while commendable, are not necessarily impact investments. How do you think about the impact of the businesses that you invest in?
I'll once again say ESOPs, indigenous equity owners. We only invest in companies that have indigenous equity owners. People on the actual cap table, people who build wealth upon exit, who are able to realize liquidity, must be from the local country. Of course, also we have, we look for 50-50 gender parity on the companies that we're investing in. So inherently, you know, we have the areas where we're not going to make investments. We don't do anything in betting. We don't do anything that's, you know, clearly we're not doing oil and gas. We're not doing, there are a number of no-nos. But if we are investing in a solution that democratizes access to technology or brings 0 to 1 technology to people, or in some way makes their lives easier so they can engage in commerce, so they can build more wealth, so they can go about their lives more efficiently, it's impactful. Yes, we have core impact businesses like Complete Farmer, aggregating smallholder farmers and helping them sell and bring to market. Of course, we have import-export businesses that give smallholder farmers access to international markets and real wealth-building opportunities. But at the core of it, if we are allowing Africans to own African businesses and allowing those businesses to scale rapidly and then sell, and real wealth is built domestically, that is impactful.
So I think what venture capital does and what sort of business investment does, so whether it's private equity, whether it's small to medium business size funding, is it moves the conversation from poverty alleviation to prosperity creation. And what Africa really needs, or what Africans really want, if you go and ask, sort of do a survey among African people, they want jobs that are dignified. They want jobs that pay them a wage that they can look after their families. They want to be able to have disposable income. And that doesn't come from philanthropy as rapidly as it comes from investing in businesses. America was built on the back of businesses, and that's why it's the most successful country in the world today. And there's more wealth has been created in America by the American businesses, by the American stock exchange, by the capital markets, than anywhere in history. So when I think about impacts, I think about jobs. And we just released our impact reports for this year. And we looked at 2 things. We looked at health and wealth because we invest in healthcare and we invest in fintech. And already our portfolio companies are reaching 2 million patients. One of the things that we also look at is the gap between the benchmark price that you'd find in Nigeria and what our portfolio companies are charging for those services. And we found that there's about a 30 to 40% difference in price between the benchmark price and what our portfolio companies are charging. 50% of all of our portfolio founders in all of our portfolios are women. And that's important particularly for Africa, because Africa is the only continent in the world where a woman is more likely to take entrepreneurial risk than a man. And when we think about jobs created, there's over 1,000 jobs that have been created just with that small portfolio, and direct jobs created, and about 12,000 indirect jobs being created. And at the beginning, I said, what do Africans want? They want jobs. They want disposable income. They want the same things as you. They want to be able to move from this sort of narrative around poverty alleviation to true prosperity. They want opportunity. And I find, even though I grew up in the UK, I find a lot more similarities. Like coming to America, I find a lot more similarities between Lagos and New York than I do Lagos and London, even though they're a lot closer. That entrepreneurial spirit is alive and well in America. That desire for opportunity, that belief that they can we as people can change our circumstances through business and through enterprise is something that if any of you visit Lagos will feel familiar to you immediately, more so than you would in Europe. And I think that sort of true impact is giving people what they want, not what you want them to want. And what Africans want is jobs. What Lagosians, Nigerians, Kenyans want is to be able to build businesses, is to be able to contribute to the world in order to be proud of where they're from. And be able to say that this is what we contributed to the world, this is what we export, this is the foreign exchange that we generate by making things that people want, by making things that the world wants. And that's how everybody reaches prosperity. That's how every country, brings prosperity to its people. And I don't think Africa is any different. So for me, impact is profit. Impact is jobs. Impact is reaching people in cheaper and more innovative ways through innovative channels. And impact is giving something to the world and making things that the world wants.
Okay, next question. Nigeria, Egypt, South Africa, Kenya, they all get the attention. How do you drive impact on the rest of the continent?
So that goes to me. So right now, we're a $30 billion fund. So we're investing in 2 highly regulated industries, healthcare and financial services. These 4 markets have really large populations. And even though South Africa is seen on a GDP per capita basis as a wealthier country, as you all know, it's actually the most unequal country in the world. So if you look at the Gini coefficient, which is a measurement of the gap between the rich and the poor, it is the most unequal country in the entire world. So GDP per capita doesn't always tell the entire story of a country, and it definitely doesn't tell the entire story of South Africa. And how do you make a country more equitable? You invest in their health and you invest in their wealth. These are the 2 big barriers to social mobility. So I think that within our sort of fund size, when you think about compliance and you think about the practical things like tax and you think about legal and you think about mastering the macros of all of those countries, don't forget we have a portfolio, or by the time we're fully invested, we'll have a portfolio of 45 companies that all need to be, registered with the central bank, that sometimes need SEC licenses, that need to be registered with the Ministry of Health and with the Primary Healthcare Authority, and we need to do their taxes, and we need to do their audits, and we need to know the compliance, and we need to make sure that they're legitimate businesses, and we need to help them expand to other countries as well, which may not be in the Big Four, but maybe outside the Big Four, but we need to be able to help them expand and help them, with all the practical things that, running a business entails. We need to master the macros in all of those countries, with all of the different nuances and all of the different market sizes. So it's hard to do that on $30 million. A lot easier to do that on $300 million. So as we continue to grow, we'll continue to sort of add countries to our portfolio. But I think if you really want to sort of make the biggest impact in Africa, then the Big Four are actually catalytic in the same way, in that if the Big Four start to develop, then, that development sort of trickles down, because the best thing that can happen to a country is to have rich neighbors. Mexico has a higher GDP per capita than Brazil. Do you know why? It's just closer to America. Like, once you have a rich country next to you, look at all those countries near China. If they weren't next to China, then their fortunes would be very different. And I always say, like, Egypt has a cheat sheet because they're near the Middle East. So they're near Saudi, they're near the UAE, they're near Qatar. So whenever something is going wrong with their economy, they always have a sugar daddy to bail them out. Whereas in Nigeria, we have countries like poorer countries, Chad, Niger, Togo. So we don't have that advantage. So if the Big Four succeed, I think it makes the whole of Africa, it moves the whole of Africa forward. And I think that those 4 countries are instrumental to lifting the 1 billion, because of their big populations, they're absolutely instrumental in lifting the 1 billion people currently living in poverty in Africa out of poverty and raising their standard of living and getting them jobs.
For us, we start with CSR biz dev, and then core investment in any market across Africa. Right now, Ingressive for Good is in the better part of 40 countries across Africa doing technical trainings, and this is the nonprofit work. What we have found, and there was this research report, Harvard, MIT, various universities have done this research report to figure out what really is the key differentiator between San Francisco and every other technology ecosystem across the world. Is it the capital? Is it intelligence? Is it something that we don't understand? And there wasn't radically different amounts of capital in San Francisco versus New York versus Israel versus other technology hubs across the world. What they found was the core difference is the average San Franciscan board or advisor, business professional, sat on 7 to 8 boards, significantly higher number of boards, significantly higher number of advisory relationships than any other ecosystem out there. And so what has been so important for our portfolio and our technology ecosystem development is encouraging the altruism of lift as you climb. So what we see is of course we have our core markets, and there's active angel investment and there's active advisory, but what we're really trying to push for in the DRCs, in the Côte d'Ivoire, in the Senegal, and as we're expanding into additional markets, is ensuring that those who have the technical skills are not only building great things, but coming behind and training the next generation, really dedicating their time behind them. And so that's really the flywheel as we're thinking about new markets and ecosystem development. So once that's stabilized, then we see angel investment coming in, then we see seed investment coming in, then we see, eventually the growth investors starting to get active. But the very first step is that altruistic and advisory relationship.
I just got the 3-minute warning, so I think we have time for one more. Digital currencies. Can you,
That's my business.
In 3 minutes, give your thoughts on digital currencies as well as blockchain? Why don't we just add more to that?
My business. The only thing I will say is, similarly, you just drop resources, you give access to people on the continent you do not need to train. Nigeria has, in years past, had the highest rate of peer-to-peer Bitcoin transactions, only second to US 1 year, only second to China another year. So the highest rate of growth of peer-to-peer Bitcoin transactions. When we find out how to make money, we'll be making money. So, but that is, we do not invest in cryptocurrencies. We are not active. Yes, it's an incredible opportunity and a more stable means of storage of wealth, or for storage of wealth than traditional currencies given devaluation. But I will leave this to the doctor.
Sorry, the question was around digital currencies and what?
Your thoughts on digital currencies
So
in Africa.
I've been writing about digital currencies for the past 2 years because my PhD is on digital currency and monetary policy. So I've been sort of researching digital currencies around the world, and that's why I'm trying to find the exact area, this 100,000 word thesis that I'm going to concentrate on. But what I will say is that I believe that Africa is actually the most innovative financial technology hub in the world. And when you think about every single innovation, fintech, banking as a service, social commerce, digital currencies like M-Pesa, Africa has taken leadership in all of those innovations. 70% of the world's mobile money transactions occur on the continent. So this is a place and an area, fintech in general and digital currencies, where Africa really is the global leader in this area. When you think about central bank digital currencies, private digital currency adoption, then you see Africa leading as well. Now, what do I think that this means for Africans generating wealth and sort of for the rest of the world? So I think that for Africans, it means that, once you find an area where you have a comparative and competitive advantage, then that's the area that you double down on, right? So Taiwan is really good at making chips, and they've doubled down on that. China is really good at manufacturing white goods, and they've doubled down on that. France is really good at making luxury goods, and they've doubled down on that. And I think that the one area where Africa should be doubling down on that can create where we already have an advantage in terms of innovation. We're great at building fintech products. We're great at digital currency products. Is this area of digital currency and fintech innovation? And even when you think about Nigerian banks have practically taken over the continent of Africa in terms of our banking services, our mobile transfer services. I mean, I really find the American banking system quite hard and quite archaic. So most people that have banked in Africa find it a lot easier to interact with the African banking system than they do the American or the UK banking system when you think about instant payments, when you think about the kind of software that we're able to build and the kind of provisions that have to be put in place to make it robust and to make it work for Africa. So in terms of sort of the future of financial technology, I think that financial inclusion, because we still have, despite all this innovation, we still have a high number of unbanked people. And that's primarily, it's somewhat a function of the income, where sometimes it's just not worth having a bank account because banking is a service, it costs money. There's still an underlying cost to it. There's an underlying cost to formalization. And I believe that as incomes rise in Africa, then the number of banked people will rise automatically. So people just need to get richer if we want to improve financial inclusion. But in terms of sort of the digital currency infrastructure, I think financial inclusion is the main argument for sort of investing in fintech in Africa. But I also really see African entrepreneurs and African innovators being able to build for the world. And I think that that's a big opportunity. The financial services market is like, one of those hourglasses. And you know how the sand has to move through this tiny choke point to get to the next person, to get to the next bit of the hourglass. That's the financial services industry. The choke point is that ecosystem of apps and banks and payment platforms. And I think that that's where African entrepreneurs really shine. Probably about 60% of the unicorns that have come out of Africa have been financial services, have been fintech, either playing in the digital currency space, the social currency space, the agency banking space. Yesterday, another unicorn was born, MoneyPoint, one of the fastest growing companies in Africa, another fintech. And if investors are thinking about where to put their money, and I'm not saying this because my fund specializes in fintech, but it is in financial services. It's an area where, Africa seems to just have found its competitive advantage. And I think digital currencies are a really big part of that. And I think that this is an area where African innovation can be transformative for Africans, but also be transformative for everybody here, everybody across the world, to be able to get paid faster, use alternative methods of payment, be able to be insulated from inflation and the effects of monetary policy that they perhaps don't like, be able to choose their own interest rates and really find greater degrees of financial freedom.
Well, we are at time. If you want to do kind of a deeper dive or dig in further on some of the questions that we've been discussing, I know there are resources. Maya, you said you often do reports, right? And are those accessible on your website?
Yeah, absolutely. You can sign up on our website. We do monthly market trends reports where we do an analysis of all the venture capital, the sectors that it's going into, the liquidity events that have happened. We also do ground up. So we'll do market surveys across the population to understand the technology tools that people are using. We do a monthly live stream on LinkedIn if you want to come on live, or we do a follow-up report. So just go on the website. You can send me an email, maya@ingressive.vc. And I'm happy to add you to the mailing list.
Mm-hmm. Yeah.
And my handle is Dr. Ola Brown. I have probably the most followed economics and finance YouTube channel, so you can find me there. I'm also one of the most followed people on LinkedIn. I have 1 million followers, so I'm always dropping information on my LinkedIn. Again, it's Dr. Ola Brown. And I sort of put all of our reports on there. So everything that comes from HealthCap, our healthcare unicorns reports comes out every year and it's updated, as well as my economic outlook for 2025. Although I have to wait for your election before I release the outlook. So I'm waiting to see who wins. I have 2 versions of what's going to happen, so I can't actually release it until I know what's going to happen in the next few weeks.